Bom dia a todos. É com prazer que damos início ao primeiro.
Good morning, everyone. It's a pleasure for us to start this first of a series of 7 webinars on Digital Real, which aims at discussing with the society the future and the guidelines for the future use of digital currency in Brazil, in addition to raising issues regarding its benefits and the best technologies for its implementation. In this first event, we are going to present a global vision of digital currencies, and we are going to discuss the possibilities of reais as a digital currency. As to start this first session, I would like to invite Professor Robert Townsend, who is Elizabeth James Killian Professor of Economics at the MIT, the Institute of Technology of Massachusetts. His papers on the principle of revelation, optimal contracts and multiple periods, decentralization of economies, and models of currencies with separate agencies separate. They have great highlights on literature. Currently, he contributes with the initiative of digital currency at MIT as a counselor and has published the book Distributed Ledger, which makes an economic analysis of the potential of DLT and examines the main aspects on its application for the market. Today, Professor Townsend will make the keynote role of CBDC digital real in Brazil relative to existing and planned infrastructure alternatives. In order to be with Professor Townsend, I would like to invite the Deputy Governor, Mr. João Emanuel Pin de Mello, who is a professor, as an economist from PUC and a doctor's degree from Stanford. He is going to talk about the impact of the new technologies on technological stability. I hand the floor to Professor Robert Townsend.
Okay, should I share my screen now?
Yes, please.
Thank you very much for asking me to give this talk on CBDC in the context of Brazil relative to existing and planned infrastructure alternatives. So let me outline the talk. I'm going to talk about smart contracts, delegation to the private sector, imperfect competition, blueprints, database, regulation, and monetary policy. So in just a little bit more detail, since this is still an outline, for smart programmable contracts, I want to talk about definitions and designs, the various options for Brazil for implementation, and a potential role for the central bank in some kind of infrastructure platform, which could in turn include CBDC. Then I will turn to this topic of delegation to the private sector, sort of opening up for innovation by the private sector. However, I have some caveats. If there isn't perfect competition and imperfect competition, there is a role for the public sector as an active participant, including CBD coins and smart contracts as competition, including competition for DeFi. Then I'll talk about these blueprints and the need for thinking through in advance, if possible, design of the financial system that includes thought given to database management. I'll come back to regulation, including the role of the public sector using the new technologies, smart contracts, encryptions, and CBDC, and end with monetary money and monetary policy, which I view as the natural domain for CBDC and the gain from implementing it. So let's talk about smart contracts and programmability or programming code. I think of this as a mechanism design problem. maximize a weighted sum of the agents or participants in a contract or multi-agent arrangement, maximize subject to resource constraints, information incentive constraints, limited commitment constraints, and participation constraints. When you have the solution, it internalizes the incentives to tell the truth on the part of the participants and to take specified actions, that is to say, to follow the recommended plan so it is consistently implemented. Smart contracts are the code that allows us to execute these solutions to mechanism design problems, and including other potentially simpler applications. It is not per se related to distributed ledgers. You can implement the code alone or execute the transfers on central bank ledgers, CBDC, but it is optional. So I'm trying to avoid the confusion between smart contracts, Ethereum, and the gains from CBDC. Cryptography is crucial. That allows privacy for incoming messages, for outgoing messages with signatures. It generates commitment to the agreement. Prime example would be, in quotes, trustless escrow services. An example is hashed time lock contract. It doesn't mean trustless. It just means you don't have to rely on a third party who you may not trust. And the consequence of the cryptography is that allows strangers to deal with one another. No need for these third parties. Allows, for example, better financial access, more efficiency, flexibility, and potentially reduces rent extraction. So as you can tell, I am a big fan of smart contracts and trying to enumerate my view of what they are about. I hope that this schemata helps a bit. Here's the smart contract in the middle of the pink box. You have these two agents, in this case, agent A and agent B, with their balance sheets. Something is happening to them in their environment, and they've entered into this smart contract. And as it evolves, they will send messages, say a transfer on their balance sheet or something else. And those messages go into the smart contract from one or both parties. The smart contract is just code. It's the only, quote, entity seeing the messages of the agents. So there's total privacy, and you do not need a trusted third party once you have this code. The smart contract executes the outcome that's already been agreed to, subject to those messages, and it will solve the utility maximization problem and execute a transfer. So this is where the ledgers could play a role, which is the outcome of the smart contract dictates, for example, one party is paying the other one. That could happen through a trusted third party, or it could be on some distributed ledger system. And it could be denominated in, central bank digital currency, but all of the latter are options, not necessities. You can use this framework we have here at MIT with my co-authors, designed auctions that allow privacy so the bids are completely concealed. There's no trusted third party, flexible risk sharing contracts that are halfway between full insurance and more rigid borrowing and lending, and allows the construction of financial and information infrastructure for small and medium enterprises. Okay, so come to Brazil. Implementation of programmed contracts in Brazil, a choice of design. So to go with CBDC, well, CBDC on distributed ledgers comes with limitations. Validation on the decentralized ledger does not scale up very easily. However, there are better algorithms. Federated Byzantine protocols, Algorand is just one example. but as I said, not Ethereum, which is quite clunky, it's slow and difficult to use. Or you could reintroduce trusted centralized parties running the ledger, or as in Corda, you can have partitioned ledgers sort of within business organizations and so on. Now, part of this also is data and data storage and calls on the data, which again can raise the specter of a scaling up problem. So that has to be thought through pretty carefully. And there are, however, alternatives, which is back to the schemata, fixing the code itself and doing a lot of things off chain to avoid the transactions on the ledgers, which can be slow and so on. Pix is a wonderful payment system that Brazil has implemented. It allows debits and credits on balance sheets, but it is not a distributed ledger. So one option for Brazil in progress is to build on top of Pix, as with open banking. Examples of where I understand Brazil may be going is buyer and seller with shipping, and then payment, invoice financing, which requires a change of the recipient of funds, delivery for value for real assets such as cars and real estate, which may need to interact with other digital authentication platforms. But the multi-party aspect of using Pix is an open question. It may be more difficult, and the current path that Brazil is pursuing is one application at a time, which means in principle, one may run into limits. Here's an alternative, an open platform which is like infrastructure to allow private sector to write any contract, essentially. EveryNet in Thailand is an example. I've had some interactions with them. There is no connection to a central bank. Now, the point here is that one can have an open public platform provided by a central bank, but then letting the private sector build on top of that, and with all the innovation that may be possible. Or you could, in principle, have multiple private sector platforms instead of the public contracting platform, if they're interoperable, and there's some evidence from hash time lock contracts that it is possible to build interoperability into multiple platforms, but the verdict is still out on that. Now, in principle, as I've been saying, you can separate CBDC from this public platform. However, you could also, as in the schemata, say that the transfer of values that is the outcome of the smart contract takes place in fiat money and could be in a digital coin. Now, that is a less ambitious goal than introducing a digital real for the entire retail population. Which you may wish to do, but in this case, you would have CBDC for the execution of values on the contracts, and you could potentially stop there. Of course, CBDC has other potential uses, and that I come to in subsequent slides. So the vision here is allowing delegation to the private sector in a decentralized way so they can innovate. Competition for trade in commodities, for exchanges of assets with broker-dealers and platforms essentially calling out prices to attract customers and execute arrangements. This can work quite well. We know this from economic theory, especially as the number of competitors, providers, platforms, and so on increases. This works for contracts, not just for commodities or assets. Competition in contracts can achieve a competitive Pareto optimal outcome along with mutualization and securitization. Things that might get in the way but don't have to. Increasing returns are not surprisingly necessarily a problem, because in many environments you get finite clusters with internal intermediation, and likewise externalities, as in two-sided markets are not necessarily a problem either. And here is the ironic virtue of the difficulty of scaling up with cryptocurrencies and so on. The marginal costs are increasing, and that can limit platform size. So again, it's setting the stage for competition among multiple cryptocurrency and crypto asset providers to achieve optimal outcomes. Now, big caveat to that slide is there may not be enough providers. So when there's imperfect competition in the provision of financial services, things can go wrong. Providers, of course, care about profits, not necessarily public welfare, and you get these trade-offs and indeed counterintuitive results where lowering an obstacle, removing, say, an aspect of adverse selection, can actually hurt the customers because the monopolistic bank or financial service provider would be in a position to extract more rents. So in fact, there are a number of counterintuitive results when you have imperfect competition. You have to identify the frictions which hurt the most. Artificial product differentiation creates rents. Spatial costs creates rents. Although that is remedied with digital banking, which is the direction in which Brazil is going. And likewise, both of the above, lowering the heterogeneity and the costs, actually provides a much bigger gain than increasing the number of physical branches of banks. Public sector can provide competition for the private sector. Commercial banks, for example, tend to not only provide credit, insurance, and savings, but act in such a way as to prevent entry preempted from others capturing rents. So then there is a role for a public bank that cares not only about its own, quote, profits, but also about public welfare. So now this is a slide where CBDC provision may make a lot of sense to ensure competition, to provide the public infrastructure, ensure a healthy market for decentralized finance, which in turn can offer non-fungible tokens, machine learning, credit scoring, customized contracts, new sources of collateral. But this public sector role through CBDC coins and through the contracting possibilities would ensure, a level playing field and minimize rent extraction. Well, another point which is related, even if we had perfect competition, we still need rules. When it comes to mechanism design and contracts, we need to think through what rules to have and to enforce. That's not related to CBDC per se, but it is definitely a role for the public sector, including the central bank. For example, ex-ante competition is good to reduce rents and so on, but ex-post competition, trying to siphon off existing customers operating under a current incentive scheme with a contract, that's bad. So you don't want all types of competition. And I have more details on this slide about how to remedy pecuniary externalities and the key role of intermediation and how to achieve coordination in innovation. But I will spare you the details for want of time. And if there is time, we can come back to that later. Another theme related to these blueprints is the blueprints and the design plan needs to include considerations of data. So again, there are rules for credit registries, for trade reporting, for atomic swaps and whether or not to allow them. Some of these are buzzwords that are viewed as important gains, but this work that I'm only barely mentioning shows that things can go the other way. So the design of the data are really a key part of the design of the financial system. We come to regulation, another role for the public sector, which involves smart contracts or distributed ledgers or CBDC. So there are financial stability concerns like bank runs and market runs, but you can solve those with smart contracts. You can implement a solution to the Diamond Did bank run problem using work of Green and Lin, which is a multilateral smart contract with basically caps on withdrawal and history dependence. Ironically, that concept comes up when we're talking about CBDC and potentially how to limit withdrawals into it as if there were, quote, a run. It's the same technology that works to prevent those kinds of runs. It's a basically programmed contract with evolving caps and so on. The US repo market is an example where there's a gain to having CBDC, in this case, wholesale CBDC, to eliminate some of the problems of multiple equilibria and lack of coordination, and also solve a problem that's becoming more and more acute, which is binding regulatory liquidity ratios, even though the broker-dealers basically aren't really holding things on their balance sheet. They're just intermediating more distant parties. And finally, distributed digital assets raise another problem, related problem of coordination, but that can be solved with revelation of certain information, which would be easy to implement on distributed ledgers, which would be partitioned for the most part, or in principle, interoperable distinct ledgers using hash time lock like contracts. So here, it's not like, do we let the private sector use the new technologies or not? Or should we preempt it by having the public sector adopt all the technologies? In this case, regardless, the public sector should be thinking about the use of these new technologies in regulation of the system and some problems which are almost surely going to arise. I come then to money and monetary policy. This is, as I put it, the natural domain for CBDC because it has to do with fiat money and the gain from introducing it. To review very quickly, competitive equilibria can be Pareto optimal, but not when there are incomplete markets. That's when we get valued fiat money, which circulates at a value greater than its intrinsic value, obviously. And we get rules for optimal activist monetary policy. On top of fiat money, we get other things like bank deposits, debit and credit cards, and so on. So multiple means of payments are prevalent in current systems. CBDC is another option of replacing paper currency with digital currency. And likewise, it may enhance monetary policy, for example, paying interest on the coin. And by analogy to the current legacy system, one could have stable coins which are fully backed by fiat and backed by central bank digital currency, of course, monitoring to make sure the backing is real. So the conclusion is so far, public and private money can coexist. You should expect both. Fiat money alone, CBDC alone, will leave gaps, which when we layer the private sector on top can help to remedy and can be quite valuable. DeFi too can exist and be very helpful in such an environment. I would recommend sandboxing DeFi in Brazil. One can think of coins that attempt to achieve stable value via algorithmic programmed money. CBDC tokens, if they're issued, could be exchanged for these private coins. The private coins are being sold to investors who want claims on physical assets. And the coins, these private coins, DeFi coins, can be traded in secondary markets. Again, the advantage is the smart contracts underlying the coins allow for pooling of resources, maturity and risk transformation, not using trusted third party. It's really just a new form of financial intermediation, and in some respects is easier to monitor in the sense that the arrangements are all exist in code before the whole thing even gets going. So with DeFi, there's an analogy to having an economy with multiple assets, varying prices. This is not a new problem for a central bank to have. So it should actually be familiar and not necessarily an overwhelming challenge. The corollary of all of this is the future has arrived. Financial systems going to continue to evolve with innovations, often desirable innovations. And so it's the role of the central bank and CBDC to evolve. And one has to get ready and think about that now rather than responding piecemeal to things that happen sequentially. So the role for the central bank is blueprints for the financial system with tracking, including cryptography, multi-party computation, fully homomorphic encryption, which allows privacy, and also automate at least parts of monetary policy with programmed money. I would just say this is an example slide of the situation in the US with respect to the central bank and the problems created by COVID. They dealt with it in two ways. One, crisis relief transfers, trying to get money to the private sector, to SMEs. It was largely not terribly successful because the SMEs had to rely on SBA and relationship banking. The other thing they were doing, of course, is creating these macro special facilities, intervening in markets, and as a consequence, the Fed yet again expanded its balance sheet, becoming an intermediary of last resort. So I would recommend, instead of these piecemeal efforts, to just embrace the notion that the Fed has a role to play in transfers and in markets, and think about guidance from theory and existing work in liquids who are important in the sense not that only they're there, but they're providing liquidity to other people. And I know for some work in Thai villages that informal systems can work that way. The US, we tried potentially to think about whether that was happening, but we didn't have the regulators don't have the data to do it, which is a comment on the data story. So in conclusion, there is a role for the public sector in the design of open infrastructure platform, which would include programmability, which potentially allows CBDC on top of it, but is not necessarily required. Private sector building on top of the public infrastructure can work quite robustly. There is a role for the public sector in countervailing competition in the public interest, certainly to develop these blueprints for the design of the financial system, including the database organization, and for a role for the public sector in regulation and using the new technologies. Private and public money can be complements, but it's important to distinguish their distinct roles. And the central bank should not think of having fixed exchange rates across all these media, but rather recognizing that different assets are going to be priced in different ways and move differently as well. So I think the strongest argument among all of these for central bank digital currency is as currency, as a fiat money and improved monetary policy going along with this innovative financial economy. So thank you so much. That concludes my formal remarks. Let me stop sharing my screen.
Thank you, Professor. Deputy Governor João, could you please start the conversation?
Thanks a lot, Professor Townsend. It was really great. It's in fact a lot to take, but it's great to have a lot to take because we have a lot to think of in terms of the avenue for the future. It's a very quick question. It caught my attention when I saw the slide. I think it was slide 11, where you say that monetary policy is the natural domain for CBDC. So just here to clarify, what one means by that is that you don't necessarily need CBDC to implement things like smart contracts, which are so I just wanted to make sure that we have this distinction in mind. You could do smart contracts with other environments, other platforms. You could also build it on top of a CBDC with some sort of platform provided by the central bank, but it's not necessarily the case. Is that right? So that's why monetary policy is a natural domain?
Yes, that's exactly right. So, what is special about a central bank? Why should a central bank be doing stuff that in principle with regulation and so on, the private sector could be doing? And the answer is the private sector really can't issue fiat money. That's the domain of the central bank. So that's the best argument, I think, for thinking about a digital currency in lieu of or as part of, paper currency, and then thinking about monetary policy implemented and what additional things could happen with in a good way with CBDC. But you're absolutely right. What you said took away from the talk is exactly the message I wanted to deliver.
Great. I just wanted to make sure that I had that right. On the, let's say, consequences from monetary policy, and I was very interested in this experiment in Thailand. When I think about, the U.S. back in 2008-9, or now the COVID crisis, the role of public banks. So one of the interpretation, the reason why Brazil rebounded so fast in 2008-9 is that, the government just told public banks to lend because they were controlled by the government. By analogy, when the Thai experiment, what you mean is that there might be a role for the central bank to directly provide liquidity to, not through, let's say, the normal dealers, but when you have a CBDC and you have this very low transaction costs, you just provide liquidity directly to, I'm going to use micro level liquidity providers that could somehow cushion this consumption shocks at the local level. Am I reading this right, or I'm going too far?
No, that's correct, but let me break it down into pieces. Initially, you were talking about, Brazil's, role of the public banks. And when I said, competition may have its limits if it's imperfect competition, I was referring in that slide to this Bank for Agriculture and Agricultural Cooperatives, which plays a very active role with branches and so on. And we have done the research with Giuliano at PUCI and shown this very interesting role that the bank is playing in stepping aside in some instances when it thinks the commercial banks will be providing financial access, but in other cases acting in a way as to guide them because they will respond to what the Bank for Agriculture is doing. So that just an example happened to be Thailand of a role for the public sector and potentially for CBDC in counteracting imperfect competition. The other experiment, which linked to monetary policy, was the idea of injecting transfers. I used COVID as an example of how they weren't very successfully injected in the US because they went through the Small Business Administration, which in turn backstops commercial banks, and commercial banks have these long-term relationships with clients. So households and small businesses that weren't banked or didn't have those kinds of relationships really didn't have access to the funding. And so the idea is and Bahamas has introduced its sand dollar with the idea of getting injections for hurricane damage into the population much more readily. But interestingly, informally, within the village, we've identified people who are there, jump in to borrow and lend and give gifts precisely when there aren't many other people jumping in. And that's the notion of centrality. Now, it had nothing to do with the commercial bank. It's an indigenous arrangement, informal sector arrangement, but it kind of validates the concept because those key players are providing insurance effectively to others by the provision of liquidity, and they get something out of it. They get higher level of consumption on average. So the consumption is like the insurance premium that they get in return for providing this kind of service. So we're pretty confident about the concept and its applicability, and would recommend central bank. I mean, central banks do sort of acknowledge market makers, right? You have these participants who are, authorized to make markets in treasuries and so on, have kind of an obligation to do that. So it's just not a totally alien idea, but the idea is to see who's in the market at key times and think about liquidity injections. And yes, so a CBDC would potentially help to accomplish that, either wholesale or retail.
I don't know how much time I still have left to ask questions to Professor Townsend. I would, if you don't discipline me, I'll use up all the time. But I do have at least one last question. You mentioned a choice between, I'm now thinking about more smart contracts, which are not necessarily essentially connected to CBDC, but could be. And there might be a choice between, let's say, multiple private platforms that are interoperable and providing an essential facility, a public essential facility. I think this is one of the choices that we probably have to make, and we did make that choice when designing the fast payment system. What are the attributes or the characteristics, like the IO characteristics of the market that we should look at? Is it more desirable to have an essential facility if you believe that there will be perfect competition for the design and provision of the smart contracts? Is there a tension here between innovating and some coordination? Like if you do it centrally, will we stymie competition, innovation, but guarantee competition at the same time? This is one of the, I'm sorry, this is in a very high level of generality, but this is one of the preoccupations that we have in terms of moving forward.
Yeah, so that's really great questions. Your questions are really, really good. So two things. First of all, if there's imperfect competition for the provision of financial contracts and so on, then some households have inadequate services and potentially, despite PIX and open banking, other households don't have much access at all. So then the issue is, how do they contract with each other? How do they assure the value transfer? Like in Thailand, they don't have escrow accounts at commercial banks. Commercial banks are nowhere in sight. So they don't have the usual services that high valued customers would have access to. So then the public bank could provide fiat money, the coin, as a trusted thing. You know what it is you're getting when you get it deposited into your account. So that's the first part of your question. I do agree that there is this tension between public provision and doing too much. So I think there is a role for public provision, but it would have to be clear that it's with guidance, providing the rules, and the central bank is not, necessarily the other party to all the contracts, right? This has to be delineated in advance. I think, we see this in many markets, like U.S. mortgage market essentially never recovered from the initial good idea of allowing, securitization, because once the public sector was involved with the subsidy, it's very hard for many administrations trying to get rid of it. So there has to be credible limits on the public, and even a small subsidy initially kind of makes sense, but it has to be viewed as like an incubator that's going to disappear. We see this in foreign exchange markets. I think some of those markets are really thin, and a big problem for traders and participants, but they're often second guessing central bank involvement in some countries, which is arbitrary, and so the traders hold back waiting for the public sector to make a move. So these are the things you want to avoid.
Sure. So in a sense, so if we were to go with a public infrastructure, you could view infrastructure as a set of regulatory rules and standards. You could somehow, let's say, for lack of a better term, settle the contract within this public infrastructure, but resist the temptation of being like a central counterparty to everybody.
Yeah.
Let the private sector solve this problem by itself.
Right, subject to the overall rules, what forms of competition are good or not, and so on. Yes.
Exactly. Professor Townsend, it's really hard to convey how thankful we are. I think our Q&A section here, we ran out of time, right, Fabio? It was an honor to be able, to be here to ask you these questions, and thanks a lot for the fantastic presentation.
Oh, you're quite welcome. Again, I was really pleased to be asked to give this keynote, and I am learning a lot. It's been quite constructive for me, and I hope we can continue to interact, and I would be honored to be as helpful as I possibly can be with all your endeavors.
Fabio.
Thank you. Obrigado,
Thank you very much, Professor Townsend. Thank you, Governor, Deputy Governor. And now we are going to go to the second half of our session. To join Mr. Deputy Governor João Manuel and to answer the questions from the audience, I would like to invite Mr. Keiji Sakai and Eduardo. The questions from the audience should be sent to the email real.digital@bcb.gov.br. real.digital@bcb.gov.br. And these questions will be addressed to the speakers. Mr. Eduardo Diniz is a professor at the Business School at Getúlio Vargas since '99. Currently, he's the chief of the Department of Technology and Data Science. His research focuses on the application of technologies and impacts on banks, governments, and society since '91. Field in which he has published many articles on financial inclusion and international conferences. Professor Diniz has a history of collaboration with central banks, always contributing for the understanding on the impacts of our policies on a daily basis of Brazilian citizens. Welcome, Professor Diniz. Thank you very much for the invitation. Keiji Sakai is the country manager of R3 and has a history of more than 20 years of leadership in IT organization and financial institutions with new technologies to help the sector to rethink its businesses. He has been the leader in IT at B3, BMF, Bovespa, JP Morgan, HSBC, and Deutsche Bank. He is an enthusiast of the new technologies of transformation, new technologies and business transformation, and he works on startups, with a close relationship with collaboration with the Lift Laboratory, which is an initiative of a joint initiative of the Central Bank and FENASBAC. Mr. Keiji, thank you very much for being with us. Thank you very much. Now I hand the floor to the Deputy Governor. Good morning, ladies and gentlemen, and thank you for being with us at the Central Bank on YouTube. It is a great satisfaction to be part of this webinar on the pathway for the development of the real as digital currency. Initially, I would like to thank the presence of all the speakers, Eduardo Diniz and Mr. Sakai, who are willing to share their standpoints on the potential of the real digital. It will be a great challenge to talk about this promising innovation, but I am sure that the debates will be sufficient for the strategic action of the central bank on the definition of the policy that will involve the existence of a central bank currency digitally. As a matter of fact, this is a discussion that the central bank has been carrying out for some time. This series of webinars that we are starting today will allow us to move forward on the discussion with the academy and the industry for the use of a digital currency for the central bank, which is commonly known as CBDB in English. CBDC, sorry. I remember that according to the definition of the Central Bank of England, between quotes, digital currency of the central bank would be an electronic form of money of the central banks that can be used by companies and families to make payments. Of course, there are other definitions that could be employed, some that are more assertive in terms of scope and others that are a lot more flexible. But this simple concept with which they maintain their feature of a fiat currency, but as a digital currency, allows for the central bank to create a study group to study formats and technologies of digital currency issued by the central bank, as well as the benefits of its use that its use can bring to the Brazilian society. The study that the central bank conducts on the development and use of CBDC is not to say that if, when, or how a digital currency will replace fiat currency. The goal is to study models and discuss the means through which technology will support the central bank in the management of currencies in its three functions: reserve of value, purchase unit, and payment means, considering a scenario of innovation and more digitalization of our society. Therefore, this is not a debate of substitution, but of complementarity of the digital space to cover gaps and overcome things that the current currency is not able to overcome, and the adoption of a CBDC overcomes the risks and costs. We must remember that discussion on CBDC in this moment seeks to build subsidies that allow us to understand the role that the digital real could play. Therefore, the discussion along these webinars certainly will help us in the strategic elaboration in the long term of the central bank, approaching the limits and the ways of the monetary authority in the adoption of this new format of currency. In a more general fashion, we understand that the use of CBDC will take place in situations in which it is able to bring more efficiency and transparency for transactions, whether they are on the retail standpoint or its use by the financial industry agents that we call wholesalers. In addition, CBDCs could bring, if well designed, opportunities to broaden financial inclusion and to increase the experience and decrease the cost or time of payment across borders. Of course, making use of this pun, we need to look at the two sides of the coin, because the addition, I mean, the sum up of gains need to be better than the losses. And this is why this is the beacon of this study on CBDCs. And the international debate on CBDC has a long way ahead. There is no standard that has been defined or a model to be followed. Furthermore, when we think of an interaction of a CBDC in different locations, there is a need for coordination so that these currencies can be exchanged in a scenario of increase of convenience and efficacy, with an improvement from the models that we have today and cross-border payments. In this context, I understand that the role of the central bank, which is the role of the central bank, is to study and follow the technological changes involved in CBDC. There are great gains, such as the decrease in the cost of production in terms of currency, fiat currency printing, and there are other changes in terms of definition of international standards, such as I said before, cross-border payments. In terms of risks, I believe that we need to recognize that we need to be very careful in the choice of the design of the technologies that are going to be used, as to avoid that CBDC, for example, disregard the general law of data protection, ensure or to avoid that it creates financial, makes it vulnerable to attacks. Also, cross-border use must have a design so that there is no substitution of the sovereign currency of one country for another. We observe, therefore, that the role of the central bank is that of researching the possibilities of the use of real in a digital currency that is efficient, creating conditions for the safe introduction of technological innovations that are innovative and that induce to innovation, setting the limits for regulators and regulated. And this is a great moment to discuss CBDC, because we have here a moment of change in regards to the way that we deal with currencies. The pandemic has accelerated the changes in the way that society moves around in terms of the digital payments. Today, a cell phone has become a fundamental key for a key element for payments, such payments, for example, through QR code or approximation. In these conditions, in the environment in which communities and people use digital solutions, we have the opportunity of debating the issue of CBDC as a complementary tool to bring more efficiency and inclusion. Additionally, the debate on digital currency fits perfectly on the strategic objective of the central bank expressed in the BC agenda of providing more competition and innovation through digitalization. Innovations such as PIX can show that PIX show that innovation can be used in terms of innovation and protection of data. Technology is an ally, and the use of CBDC is not controversial. Much to the contrary, the choice of right technology and the adequate use of these technologies will allow for the improvement of the system and ensuring the safety on the system, in addition to working with other results such as incentivizing cross-border payments and financial inclusion. We cannot foresee how this currency will be perceived by the citizens of the future, how the population is going to use on a daily basis. But we can say that there will be a significant migration from fiat money to digital currencies in terms of payments, and we believe that this will also go through CBDC. The pandemic has shown us that this movement can, as a matter of fact, be accelerated. With that, the role of BC is to get ready and even anticipate these movements of innovation and propose an environment in which that receives it, that welcomes it without creating hindrances, and ensuring the safety of data of our clients. It is also mentioning that the measures such as CBDC has to be taken step by step. so that we can assess the benefits of innovation and define the necessary regulation. This is how the central bank acted on payment since 2013. There has been a series of changes going through the ending the monopoly of credit card providers, going through innovation in payments, reaching PIX, which allows instant payments 24/7. These are changes that have been captained that pave the way for a more efficient and competitive financial environment. This strategy is gradual because in financial terms, solutions are never simple. They need to be taken synergetically. Therefore, the adoption of real as a digital currency following the perfect guidelines will broaden this path. And this is why we are here today, debating ideas and exploring cases on the use of CBDC. To conclude, I could say that the strategy of the regulator is to foster strategic reforms that deal with the market with the potential of promoting benefits of long term to the society. That way, the central bank seeks, in this context of innovation, to allow consumers to take advantage of the great benefits that these changes will bring, to the step that it will zeal for the protection of that of our citizens as well as companies. The development of a CBDC system and for the Brazilian payment system is a piece of this puzzle. In addition to the other technologies such as Pix, Open Bank, and Hash. This way we have more tools to allow for the power of purchase of our currency, zeal for the fiduciary power, as well as the financial welfare of our society. I would like to thank once again for the opportunity for this debate, and I would like to hand the floor to Professor Eduardo Diniz. Once again, I would like to thank you for the invitation. To me, it is a great honor and a privilege to contribute with these discussions along with the central bank. We are in a process of evolvement that is very fast in this process of payment systems all over the world, and the central bank has been an important stakeholder in the sense of being proactive in the construction of this infrastructure of this pathway to massify, in other words, to help to massify the digitalization of the payment means. We have been following this since 2013 in the regulation of payment arrangements, and now with the PIX, this shows a lot how the central bank really has changed somehow the scenarios in terms of adoption of digital payment system in the society. I mean, to talk a little bit more about CBDC, I believe that we need to demystify a little bit for the general public what it means to have a cryptocurrency or a crypto real, what it means. In fact, what we need to understand is that there are three levels of articulation that somehow are levels of governance in which this process takes place. On a first level, you have the level of the rules of fostering of the market. In other words, how the currency, how much the issuing of the currencies. So you have a level of control of the rules of the process of the payment system. So on a second level, you have a process of validation to define what is real. In other words, you have a piece of code that is circulating. People are talking about a digital system. In other words, there is something there that needs to be validated, that really that needs to be validated. And there is a third level, which is a level of the code itself in which all of this process is built. In order to make it more understandable, let's make an analogy with the system of fiat money. When you have fiat money, all of the rules are built. The rules of the payment system are built and proposed and even inspected, implemented by the central bank. Now, you are going to have in the second level that I am calling the protocol level or the level of validation, for example, the role of the mint, which in fact builds an object that says that that is money, that is validated as real money. And you also have another level which is a code in the payment system. You have the whole infrastructure, technical infrastructure to the production of this currency. So you have machineries, printings, printers, ink, all of the techniques that are used to do that. So now these three layers, they operate as a set to make the system run. Now, what we are seeing here is the proposition of the transposition of these layers that today have this mechanism in the physical world with the fiat money to a digital world.
So you'll keep on having it. You'll keep on having control of the rules of how the payment system works. This will keep on being at the hands of the central bank. You'll have a validation system also. You'll have to have infrastructure to be able to validate that what's circulating is real, really. All players involved in the exchange, the payment elements are that this is effectively real, which is circulating. So you'll have to have an infrastructure, as you have the Mint House today, which is the guarantee that the bill is a valid bill. You'll have an infrastructure, a digital infrastructure, to assure that that process that's going on is happening with the use of something that is equivalent to R$1, is valid as R$1. And you will have the whole building construction of this technical part that we call this layer, which I call code, where the smart contracts will be, that Professor Townsend mentioned. You'll have to place all interoperability issues, predefined standards, all these other issues are defined at this level. So basically, what we have to understand is that when you migrate from one system to the other, you will keep the same logical structure of the payment systems. So you'll have the central bank keeping on to have control over the rules of how the market works. You'll have a mechanism for validation, necessary validation, to say that all that's being operated is being operated with tokens that are validated and that can be trustworthy for the population doing the transactions. And you will have also this discussion at the code level, where you will implement the technologies, how you will execute them and make them work, considering all the technical elements involved. How, well, as you have in paper currency, all the impression system, the printer system, sorry, establishing safety of currency, and you will have in the digital currency, the digital real, you'll have the system based on technology code that will take care of the interoperability part, the establishment of standards, so that will monitor the process to assure that it should become feasible. Having said that, it's just an introduction. We'll be able to talk more, but I'd like to begin saying this so people understand that we are doing a transposition from the fiat real to the digital real, but we won't lose. So this whole structure that assures trustworthiness in the system, so that's important for people to understand. So we are not creating something that will breach the structure. This will keep on happening within the implementation of the digital real. We can talk a little more, but I would like to make the opening with this didactical, this teaching side so people understand what we're talking about. And now I pass the floor to João Manuel. Now, for his considerations.
Ok. Bom, primeiramente, bom dia a todos.
So, good morning, everyone. First of all, thank you,
João Manuel, professor
Deputy
pelas introduções aí.
Governor João Manuel, for the introductions that make my exposition much easier. I'd like to bring a different context, the discussions regarding the market opportunities. First of all, I think we have to mention the beginning of the CBDC discussions in Brazil. We realized there are many people with many opinions, even conspiracy opinions of George Orwell, control over the financial transactions. We have to demystify this a little bit so we come back to reality. Digital coins have many business opportunities and a need to reposition many financial market entities. Some things that I think are very relevant is that we're discussing more and more a digital world, and in the digital world you have more and more electronic transactions, and these electronic transactions need to have more efficient means to be done. So Professor Townshend mentioned cars and real estate registry, and at some point we expect all the registry for these transactions to be electronic. So the whole electronic process, the financial liquidation, we are still in the old systems. For the most, we have the PIX, and we can do PIX today. There's this issue related to what Professor Townsend meant regarding DVP, delivery versus payment. There's always a gap between transferring an asset or delivering something that you sold with receiving the money, and that can be solved through an e-currency, and that also brings changes regarding some entities that render service to the market, providing assurance to this kind of transaction. So now we do these transactions, and these transactions don't generate worries or have no risk, because we believe in a third party that assures or guarantees the delivery and the payment of these transactions. So from the moment we begin to do this automatically onwards, even mentioned by the atomic swap, the simultaneous delivery of an asset regarding payment, you begin eliminating the need to have third-party service accredited, so you begin having reductions in tariffs and costs, basically. So I think that's a major discussion we can approach, and there are many discussions also regarding what platform we're going to use. Are we going to use DLT? Are we going to use traditional technology? No, the market will move forward naturally. There are some assets, there are some businesses that will happen in the given platforms, or others that will happen in other platforms. My opinion is that in the implementation of digital coin, it's necessary to have a study, an assessment to assure interoperability, as Professor Eduardo mentioned, of different platforms, and for that we have global discussions ongoing regarding protocols of interoperability between networks and technology. We can explore a little more on that, but a brief introduction. Once again, thank you very much, and I give the floor back to Deputy Director João. Deputy Governor, pardon. Thank you very much. I, as moderator, will allow myself to ask the first questions, and then we'll choose. Unfortunately, I'll have to choose some questions from the audience because there are many and we won't have time to ask them all. I'll begin with Eduardo. Eduardo, how do you see the readiness of Brazilian public in adopting the digital real in national scale for retail sales? And the public on one side, let's say, if you can think in financial education, would people be ready with the necessary understanding of what this new digital format for Real, this new format is. Thank you for the question, João Ricardo. It's curious, as a professor in information technology, we convive with this readiness studies very much, how ready people are to accept a new technology, right? And it's curious that one of the interesting things regarding these readiness studies is that they come from a given logic, that people are always looking to the past. People are ready to accept a new technology that they don't know. So let's just make an analogy. We could ask that about Pix. Are people ready to accept Pix before knowing what Pix is? Probably not. But the thing is, when you use Pix first time, it's enough for people to adopt it very quickly. Pix is clearly a success case. In the same way, likewise, many other technologies we're talking about, João Manuel mentioned the cell phone technology. People very probably before using a cell phone, they weren't ready. They didn't have readiness to use a cell phone because it wasn't part of their routine, wasn't part of their logic. From the moment they use it for the first time onwards, the perspective changes completely, because what happens is that when you realize, and once again I'll mention Pix, when you realize immediately the benefit this brings you, you change automatically. I remember having talked to some people about Pix before Pix was launched, and it's like this. I heard a certain mistrust in the comments. How so? Are we going to make a digital payment? It's going to be automatic? What assurance? Won't it be dangerous? Anyhow, before it existed, before people used it for the first time, they had more mistrust than from the moment they first used it onwards. So I think the readiness issue will remain clear. Actually, when you present the service or the product and people begin using it, and then they realize, and in this case I have full belief that the adoption of a technology as digital real will bring clear evident benefits to people, and they will realize this and will adopt it. The readiness is generally not a function because of something people don't know. When they start using it, is that they will understand what being ready means. So the adoption process may be very quick, as effectively we are used to seeing in some of these cases. I mentioned cell phone and Pix as two examples of technologies that in a given way, before people knew about them, they had no readiness about it. So when they get to know it and start using it, readiness transforms itself. And then I believe this very strongly when we talk about digital health. As soon as it's in operation, when people see it work, I think the major possibility of having a quick adoption for this new type of payment system will be a reality. Thank you, Eduardo. As a moderator, I must keep on asking questions, but I'll have a brief comment here. It's difficult to agree more with you. It drew my attention to see a report from the media yesterday or some media channels that said almost half of the Brazilians, 46% actually, this is an open banking issue, a fear sharing their banking data. I was surprised when they said it didn't even work. You mean 54% don't fear it? I think it's a high number, and our role And after it comes in, as Eduardo mentioned, with all fluency, people will understand how easy it is and understand the benefit, and will certainly see it's very safe. The safekeeping of their privacy and the personal data, and surely the number of the ones who don't fear it will increase very much. Keisha, you mentioned here something that to us is very dear, very important, which is in the design, the generic design, whatever it should be. You mentioned, Eduardo also mentioned, but this is to you. It's important to have interoperability, meaning we already have, in the end, many payment means, many of them digital, as a legacy, rendering good service to the population. How do you see interoperability of Real Digital with other arrangements, or with PIX or even others? In other words, I know it's a generic question. Sorry to ask it like this, but in your view, which would be the best way to integrate digital real to solutions already ongoing for digital payments? Okay, first of all, digital real will be an alternative for payment, and integration has to be more than natural. So it's complementary to what it already exists. It replaces in some situations, it provides alternatives in other situations. So to me, integration of digital real to PIX for the local transactions, and as already mentioned, for the inter-border transactions, and then there's a next spectacular advantage, and it depends in many easiness, very many features existing in a CBDC digital coin, which is the issue of programming the money, depending on what you define that's going to be used in this programming. For example, money, conditional money. We could create conditional currency, money with trigger. It's were valid from some date onwards, or it's not valid after a given date. So there are features that can be implemented for this programmable money for a different need from each business. This issue of conditional money is one of the things I think of very very dearly, because once again the issue of operations liquidation, where you are subject to the delivery, DVP, delivery versus payment. So if we were able to somehow link the signature of the contract and the liberation of the money that's already in the account of who received it for the sale of the assets, we would eliminate many risks, and eventually, if the contract isn't signed, the money is not activated, so to say, the activation of the money. So to me, CBDC comes complementary to the other payment means, replacing some and bringing more alternatives, eventually cheaper alternatives for the ones using. Just mentioning something about the readiness issue. I think creativity here in Brazil is interesting. Recently, I got a WhatsApp message indicating a possible PIX fraud on scheduled payments. I said, scheduled payment isn't even launched yet. It will only be launched in a few months, and they created a fraud that's already ongoing. So resistance we have regarding innovation is so normal in Brazil. So we normally say this viralizes. So CBDC will be the same. There will be many people against it in the beginning until they understand how it works. So it's up to us to clarify that to the market. Very good. I'd like to ask a question for both of you, a question that Welton from Da Silva Melo sent us. I think you two are particularly, apart from the other issues, but particularly fluent in this dimension, which, and this, and Professor Townshend also mentioned this, but I'd like to listen to your vision of you two. Which would be the largest benefits that from the implementation of digital health under a decentralized architecture, and instead of a centralized one? You, just to invert with Keisha, your view one choice against the other. First of all, I think there are successes, situations of good uses, centralized as well as decentralized, taking advantage of the DLT technologies. There are some functionalities that are easier to be implemented because they are native to the technology. So when we talk about smart contracts, there are no smart contracts outside a blockchain DLT platform, but within a platform like this, there are some facilitators to ease the implementation. So there are issues regarding the distribution, distribution of the ledger, of the accounting information. Also, we would also benefit from a DLT technology for this kind of implementation, except outside this, the whole world is adopting different technologies, and DLT is the most used ones. And there are many tests and experiments that guided implementation to technology. Professor, any other ones? No, just to complement, I think that logic to think of distributed technology is to increase robustness in the system. We're talking today on top of a platform called internet for distribution. So this mechanism that exists today, and to us it's who are users, and this is very robust. It only keeps on going because of its distributed structure. So you don't have a centralized system is always running a risk, and when you concentrate all information, so where you concentrate everything is always the spot, the weakest spot in the network. Internet actually exists and works because it was built based in this distributed logic where you have no spot on the network with a degree of vulnerability, because we're talking about systems, technological systems, and everyone who has any kind of machine knows that any kind of machine, any technology breaks, presents problems, and certainly when you need it. So the fact that you establish a logic on top of a distributed infrastructure, a main gain from all this is to increase robustness in the system. So it's the system that ends up becoming less vulnerable exactly because it's based in this distributed infrastructure. And then I think the internet example is the best one we can have to show how a distributed infrastructure has robustness. It'll be difficult if you compare, for example, we ones that are a little older. We had the phone system where there was a centralized logic. We called phone central machine. If you have a problem in the phone central, no one else talks. Everyone ceases to talk. And in the internet, if you have some problem in some spot of the network keeps on working. So you assure a level of stability that's very much larger. So resilience, words we can associate that are part of the logic of a distributed infrastructure. So you will incorporate these elements in the distributed logic in this new infrastructure within the digital coin payment system constituted on DLT. So I'd say it's the main gain you will have. You have additional gains, I think, apart from this one. You have the possibility to create mechanisms with a larger degree of transparency. You have possibility to create mechanisms also for larger social control over what happens in the network. So you add this, and it's not by any other reason that these infrastructures based on distributed networks, DLT, are gaining space. The difficulty is to learn how to work with this. It's a different logic from what we traditionally used to implement. We are used to the centralized ledger system logic, all information being in one place. So we have to begin to learn how to work with this. So I think the largest difficulty is our organization logic and not technology. I am absolutely I believe we are going irreversibly to the implementation, more and more common implementation of systems based in DLT.
Thank you very, very much. It's a lot of information you have brought to us. So let me ask a question. Since we don't have much time, I'm going to ask the both of you. From the technological standpoint, if you could focus on this dimension, what cases of use do you think that are more viable and should be considered when we develop a digital health, or what services a case of use should be, let's say, priority when it comes to the process of design? May I start? Mr. Eduardo is asking. Sure, go ahead, Mr. Eduardo. Well, in fact, this is the secret. In our studies of adoption of technology, we wonder what would be the key application, the application that we would make the use of an infrastructure such as this actually take off. I tend to think that you would have to get into, I mean, two strategies maybe. Maybe coming in a place where you have some efficacies, in other words, where you can have great gains in terms of, for example, in some areas of the payment system where you could have very quick gains. In another strategy, you could have gains in adoption that could be the same. Now, on the quick adoption side, we have some platforms that we could start to think in terms of use of this kind of technology that would be important. The first of them would be the adoption, massive adoption, for example, such as the Brazilian financial aid from the government called Bolsa Família. Today, this is based on digital payments down to the front line, and in the front line, you give in a card to the user. What has happened with the pandemic is that the level of adoption of digital payment increased on the front line. So I would follow a logic of massive adoption, thinking of an infrastructure such as that of the Bolsa Família. On the other hand, there is the other side where you have gaps that you could fix. For example, you have systems in which you need to have more control and transparency in terms of the transactions. We have been tired and sick of seeing a high level of corruption in which we have bags of money being going from one side to the other. In other words, there are some points in which there are frailties in the system where you could come in with with strategies to reduce these problems that are so well known. I think that there are these two strategies that we need to think. In other words, one, where there are problems that we're able to tackle, and the other, where we could have a strategy to contribute for massive adoption. So these are two possibilities of trends so that you can make an initial implementation and create what we call a key application for the adoption of the so-called digital real. Thank you very much. Now, Mr. Key, the floor is yours. I agree 100% with Mr. Eduardo. I'll just like to bring another issue, which is where we have the market opportunities. So throwing the ball to the private initiative, we see many situations in which at our lift, in the last few years, we've had a lot of projects that seem to be very interesting in terms of tokenization. If you don't know what tokenization is, that is the digital representation of something. We hear a lot about NFTs, but there are other kinds of tokens or tokenizations. And we found a lot of interesting projects in terms of tokenizations in which, again, we faced the problem of liquidation. Some of these tokenizations were related with physical contracts that needed to be registered at the at the central registry, but this registry would only be, I mean, the payment should only be made after the contract had been signed. So the mechanism that was found was to get escrow accounts, which means costs in transactions. And of course, for this kind of opportunity, some of these costs may render the process not feasible. So we've had this kind of opportunities, but we know that there are a lot of inefficiencies on the market, or maybe we should say some deficiencies that are outsourced or outsourced deficiencies, things that the system as a whole doesn't allow, so you hire this system from another. Now, this outsourced deficiency could be eliminated from the moment that you're able to make processes that are more, or I mean, if you have a chain of a process in some kind of negotiation or some kind of product, so that you won't need to have third parties. From the financial market, there are great opportunities as well, not only in terms of tokenization, but also many designs of implementation of CBDCs, in which we consider the possibility of the stable coins that are issued by a bank that they call synthetic CBDC. So it depends a lot on the model that is going to be adopted in Brazil. Now, the big problems that have been solved in the world, we have already tackled. For example, for retail, CBDC is being used for the instant payment, such as Pix. And in wholesale, CBDC is coming to solve problems of banking reconciliation for those who don't have the RGTS system. In other words, the real-time gross settlement system. And now we have the SB since 2002. So we look outside and we try to find what are the great benefits. The benefits that happen abroad are not going to be the same we find here. So I think that these problems that the professor has brought, like mass adoption, as well as take better advantage of the opportunities, making our system a lot more robust and a lot safer, mitigating risks through technologies, making the whole chain cheaper. I think that this is the secret for the implementation. Fantastic. Thank you very much, Professor Diniz, Professor Cage. If it were up to me, we could spend a whole life here talking about this issue. But maybe we could order some food to go and eat here at the table. But unfortunately, time has run out. So I would like to thank the audience for all the questions that have been sent. Unfortunately, we haven't been able to ask all of them. But during these webinar processes, I am sure that we are going to answer all the questions in this co-shared fashion. I would like to hand the floor back to Mr. Fabio. Thank you, Governor João Manuel, Deputy Governor, Mr. João Diniz, Mr. Diniz and Sakai. We've got a lot of questions from the audience, and these questions will help us in terms of the setting up of our project. In spite of the time, because of the time, we will not be able to answer those questions, but they will be taken into account during our central bank assessment. We have come to the end, and I would like to say that the next sessions will be broadly publicized in our online platforms, and the next event will take place in 3 weeks. Thank you very much. Thank you very much, everyone. And we wish you all the